Thank you for joining me. I'm Alex, and I would like to have a look at the Unilever group. And that's mainly because we did Colgate-Palmolive yesterday, and they're pretty much the direct competitor. They also do consumer goods, mostly household chemicals, but a lot of other stuff as well. Current price is $56, which gives the market cap of $148 billion, which is down 9% today. Dividend yield is 2.92% with a payout ratio of 45%, which is certainly not bad. Revenue $51 billion, no significant growth last year and before that as well. They haven't really been growing for the past 4 years. Earnings of $9.4 billion, which is up 50% from the previous year, which is certainly a good thing. PE of 22, which is not terrible, like just above the threshold that Benjamin Graham used to set. Total assets $59.5 billion, which is down slightly. Total liabilities $47 billion, which gives them a total stockholders' equity of $11.6 billion, which is down 20%. And you might ask why that's down when they're making so much money. Stock buybacks, basically. So not only are they paying almost 50% of their earnings in dividend, they also buy back shares for like $4 billion. So balance sheet is still good because obviously stock buybacks are not hurting them necessarily. If they really wanted to, they could just sell those stocks again and make the money back. So as far as risk factors goes, it's pretty much the same. Nothing really changed recently, and nothing is going to change in the near future. Obviously, companies in other countries like China and India are working on things, but that is not necessarily a threat for them in the near term. So, for some reason, China does not export a whole lot of household chemicals and that kind of stuff. So for now, that's reasonably safe. I really don't know if China has any big companies working on things that they are starting to export. I honestly don't think so at this time. So risk factors have been the same for the past few years, and I don't see anything changing there. So to sum that all up, obviously growth investors are just out at this point. Dividend investors, I think, will find a fairly interesting stock here because the dividend yield is not bad. It's not great necessarily, but definitely not terrible. The payout ratio is nice. And the stock buybacks mean that you're going to own a bigger share of the company as long as they keep buying back their own shares. So that means that the dividend is, first of all, more likely to grow, and second of all, easier to grow in bigger increments than if they didn't buy back their own shares. So that means this is probably a decent dividend growth stock. But obviously you cannot predict the growth part of the dividend growth stock. So balance sheet looks good. P is slightly high, but nothing you can do there. Dividend is decent. Payout ratio is nice. And the stock buybacks will help you down the road, probably. So for dividend investors, this is a fairly interesting stock. For a value investor, I think that pretty much the same holds true. In both cases, the shrinking revenue is kind of a problem, but not a big problem. If you're a strictly value investor, I think the PE is slightly high. The balance sheet is not great. It's definitely not terrible. It's a decent balance sheet, but it's not great. And I think that, the dividend makes up for a lot. So I think for a value investor, it might be worth looking into as well. So if you're a dividend investor or a value investor, do some research and figure out if this is something you want to invest in. On paper, it looks pretty good at this point. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.